Bob Archer. I'm in the Marin chapter. My background is economics. After college, I was in the Peace Corps in Colombia. And for 25 years, I worked with the Agency for International Development on electricity sector reform, regulatory development, and energy efficiency in Eastern Europe, the former Soviet Union, South Asia, and East Asia. My objective here today is to give a presentation that looks in depth at European cap and trade and the U.S. cap and trade. In Europe, I'm talking about the emissions trading system, ETS, and in New England, the 9-state initiative called RGGI, Regional Greenhouse Gas Initiative. Because of the limited time, I'm going to just hit the conclusions on these, look at the British Columbia tax in a brief way, and then do a comparative on those two. The reason for doing this, I think, is to get into the carbon pricing issue, cap and trade and the carbon tax. Our congressional discussions are getting deeper, and CCL is building relationships with groups that are engaged in cap and trade. Now, one note, actually two I would make, is the carbon pricing term is used and is growing in use. It tends to conflate cap and trade and the carbon tax. Cap and trade requires carbon markets, carbon credits, allowances, and trading. Our fee and dividend requires none of that. So it's a very important distinction going forward. I would also add what Severin Borenstein said, think about developing countries. What is the impact of the policy alternatives in that context, and not just the U.S. European context? So cap and trade, very quickly, how does it work? Governments set a cap, a declining cap. It's often based on a business as usual forecast of what would happen without that cap. In Europe, that covers 11,500 industries, and in New England, 168 coal power plants. So emissions are issued equal to that cap to all these emitters, and they have to, at the end of the period, turn in allowances that are equal to their emissions. If they emitted more CO2 than planned, they have to buy more, and if they emitted less, they can bank those or sell those. There are a lot of bells and whistles on cap and trade, borrowing, banking, extended compliance periods, reserve funds, offsets, which you heard some discussion about already. And most are aimed at smoothing out the process of cap and trade. So the theory is the cap declines, allowances decline, the allowance price goes up, industries look at that cost, then they make the investments. In long-term investments as well as short-term investments, and emissions decline. This is our proposal. So what happened in Europe and in New England? Emissions declined 2008 to now, but the key issue is, what was the impact of cap and trade? It was not really causal. Causality is a key issue in looking at the environmental policies. The ETS, I think a fair characterization, it had limited but non-trivial impact on reducing emissions. In RGGI, very negligible impact in New England. There are two things at work. Some fundamental problems with cap and trade, but external issues that I don't think cap and trade handled very well. Economic recession. Economies in Europe are shifting from heavy industry to services, as they are in many places, and expansion of renewables and energy efficiency under those programs. And of course, the emergence of natural gas, which had a major role in displacing coal. So what did you wind up with in this forecast of the cap? A flood of allowances in both of these programs. And when you have a greater supply, you wind up with very low prices. This is a characteristic of cap and trade globally, which I'll get to. So here's a chart on the price trajectory of the European system ETS, 20 to 30 euros initially, and it's down to 5, 6 euros, $6 or $7. So what does that mean? You have surplus allowances, lower prices. It means there was no real incentive to make the long-term, significant, low-carbon, no-carbon investments. I think that's why Bill Gates came out in terms of a carbon tax, to stimulate the innovation and create the environment for those investments. One of the serious flaws, a global flaw, is the calculation of business as usual. This is a significant factor in how you determine what your cap's going to be. There has been a significant oversupply, and as financial traders said, the practice of overestimating emissions is so widespread that it suggests a bias in the system. This confirms the theory of Professor Bill Nordhaus at Yale, who wrote The Climate Casino. It's a win-win for governments and countries to overestimate the business as usual and to keep that cap relatively high. There's a systematic surplus that has developed. The flexibility tools I mentioned have really not worked in terms of impacting the price and allowance situation. I didn't mention that Europe is about $6 or $7 per ton. New England is about $4 or $5 per ton. California is 12. Cap and trade's very slow to start, 2 to 3 years to start up. British Columbia, it took 5 months from the date of announcement to put their carbon tax in place. So that's a significant difference. Likewise, adapting to the problems and changes took almost 5 years in both systems. Fundamentally, you heard Severin Bornstein this morning, is that cap and trade can't anticipate the economic and energy changes ahead, which it must do in a reasonably accurate way to have a reasonable trajectory. You have economic recession, the renewables, natural gas, and electricity reforms that all altered the scenario. Trade vulnerability is an important issue for subnational systems, and most of these are, which means they can't put up a border adjustment of carbon duty like the CCL proposal does. So what you have are efforts to deal with that. In Europe, they gave free allowances to a lot of industries. Okay, little help. I didn't warn you that, spoiler alert, that there are very few pictures in this presentation, so I think you know that now. What's happening here? Next. Okay? Good. So the subnational program issue is that it's an issue for any program, British Columbia as well as California, etc., and how you deal with free riders in Brazil and elsewhere. And once your industry's prices go up and the cost of production go up, they're vulnerable. Have to have a national program with that border adjustment. So the windfall profits are built into that European system. And what's built up is a significant number of interests because of the complexity of cap and trade and the number of organizations involved. Emissions coverage is only partial, 40% of emissions in Europe, 22% in RGGI in New England, and the British Columbia tax is across the board. Here's an interesting one I've been asked about, and it's a policy conflict. What happens when you have renewables energy efficiency programs? Those undermine your cap and trade system. They do that because they work. The renewable energy projects that are in place and energy efficiency reduce emissions. They create room under the cap. And in Germany, it allowed more coal power plants to come online. This is an issue in California that was just laid out in some of the legislative analysis as well. So what happens to the revenues? They kept all of them in Europe. Most went to general fund. Germany put it all on clean energy. And New England, it went to a lot of energy efficiency. But this is a characteristic globally. Cap and trade tends to keep funds. The carbon tax tends to be more toward revenue neutrality, and that's a Stanford study that looked at all of that. I'm not going to go into the Kyoto Clean Development Mechanism. This has been, I would call it, abused. It really has contributed to an increase in emissions. There's a lot of analysis on this, but you can see for an industry in Europe, they could go to the three main clean development mechanism countries, Ukraine, Russia, and China, and buy carbon credits from clean energy projects in those countries for 15 or 20 cents per ton. So if you're a business and you go do that rather than pay $7 in Europe, you can see what the problems are. This is one of the indicators why I think cap and trade is really going to be problematic in developing countries with weak institutions and corruption. The papal encyclical got at this issue, specifically because of this issue and relationship. Carbon credits, speculation, would not help reduce emissions and would maintain the excessive consumption of some countries and sectors. That was aimed directly at the ETS and the Clean Development Mechanism. It was not aimed at carbon tax concepts, as some have maintained. Specifically, some issues about the European system. Causal link was very weak, as I said. The surplus allowances, low prices, low investment, mostly short term. Bottom line is carbon price really matters in terms of driving investment, and that is clear and consistent in the independent evaluations. Now, the greater the company's carbon intensity in Europe, the more they tended to get allowances. There's a perverse relationship there, and that obviously creates heavy lobbying. Free allowances go to 147 industrial categories with a predominance in the heavy industry sector. You see all these categories: iron, steel, coal, petroleum, etc., etc. My two favorite are perfume and toilet preparation and wine. So you see the lobbying that is involved in this free allowance approach. The design of ETS, cap and trade, is a burdensome, flawed, slow process. You often hear, it's not cap and trade, it's really those external issues. It's both. And the business as usual one is really quite significant. I think this summarizes pretty well what happened. You have limited, you have your fundamental problem of the limited impact, allowance surpluses, low prices, low investment. The design issues are slow and inhibit the effectiveness and the responsiveness and predictability. And the flexibility mechanisms haven't handled it. And then that carbon leakage border issue makes it very difficult to raise prices to $20, $30, $40, $50, $60, $70 unless you're a national system. Once again, I'm sorry. Okay. RGGI, cap and trade in New England. About the same time frame. It took about 3 years to start up. 9 states in New England Middle States. A regional agreement and state level markets. There was really no causal relationship here, fundamentally. There was some in Europe. What happened? Many of the same things. Natural gas came in, scheduled retirement of coal plants, renewables, better use of nuclear and hydro capacity. So allowance prices collapsed. Likewise, with that low price, you have the same investment issue and impact. This 47%, 50% of the money retained by these states went to energy efficiency programs, and those worked relatively well. Some say that's the real success of the cap and trade program in New England. And only about 8% to renewable energy and 12% in direct bill assistance. This is a chart that shows the number of allowances offered every year, how the blue line is how infrequently sometimes they were taken up. And you have 5 minutes. You have a low price there, a green line, about $3. So I'm going to go on to the expert opinion of Professor Robert Stavins of Harvard, who says basically the RGGI experience has been essentially irrelevant. Now, there are some narratives that don't match up with this experience. The cap guarantees reduction. It did not do that in either of these cases. It was a cap chasing events. Cap and trade works. ETS has achieved immediate and significant emission reductions. RGGI's achieved emissions well below the cap. The independent evaluations do not show that causality. These are comments and reports from the Environmental Defense Fund and International Energy Traders Association. Cap and trade is market-based. Not so much. It's an administrative market with one dominant supplier. And it's a problem with cap and trade. It's all those other things. In fact, it is inherent in cap and trade, a lot of the structural issues as well as external issues. Price doesn't matter. In 2008, that's what Professor Stavins wrote, that it does matter. It does matter. You've got to have the price trajectory to get investment. 2012, since when are low prices considered to be a problem? Cap and trade is simple. That's an Environmental Defense Fund website. Cap and trade and carbon tax are essentially the same. I noted the differences between them, conceptually and experience. It doesn't damage the economy. That's the issue of subnational cap and trade and carbon tax. If you have a $70 carbon price, it will. So the British Columbia carbon tax, successful, $10 rose to $30. Revenue neutral, equity was met. It's 4 to 5 times the price of the cap and trade in the same time period. That's really the proof of the pudding. And the emissions impact, 13% per capita decline in British Columbia compared, and that was 3.5 times the rest of Canada. Economic impact, about the same, neutral, maybe slightly better. Equity impact, progressive. Public support increased. You do have some trade vulnerability. Agricultural greenhouses were getting hurt by California and Mexico, which did not have to pay this tax, so they exempted them. Comparative criteria. Next group will go into this somewhat, but I want to emphasize 5 particular criteria. One is effectiveness. Cap and trade was not effective. Fee and dividend in Canada was. Efficiency. Did not have the reach of the 100% coverage of the carbon tax. And equity and fairness in cap and trade in Europe. Household prices went up, electricity prices. Industry had the windfall profits. This is an important one. Ease of administration, which does not get addressed in the context of the global scene. Design and implementation complexity. Administrative discretion. When you have weak institutions and serious corruption, which 21 countries have, both of those based upon World Bank, Transparency International indices. They have over 50% of the emissions. That's what we have to think about when we're advocating one or other of these policies. Transparency, alignment of policy objectives, I mentioned with the cap and trade, doesn't work very well. Carbon tax is very neutral in that regard. Stability and predictability, really important. That price trajectory to get the long-term investment. Political economy in the U.S., you all understand that. And the political economy in developing countries, I come back to that as my last point. Remember and think about Indonesia, India, Nigeria, Ukraine, when you're talking about which one of these should we choose? a carbon tax in its simplicity and transparency and building on existing Ministry of Finance capacity, or cap and trade with its complexity and control by political and economic elites. A carbon tax with that dividend addresses equity issues and efficiency in those countries. And that is, I think, one of the strongest arguments for continuing to do what we do. We do what we do because it's politically achievable. We have a national approach, and it's going to work around the world where it has to work in developing countries. Thank you.